All right, I'd like to welcome everybody to the third and final edition of our webinar series. And once again, it's brought to you by both Morrow and Entrusted. It's an honor for me to be representing both of these companies that take a human-first approach to financial advice, whether it be pre-retirees or estate planning or other financial services. You can learn more at the websites that are listed at the bottom of the page here. And this is Reclaiming the Cost of COVID, personal finance webinar, again, session 3 of 3. Here I am, same picture, same story, don't need to review that. We can take a look at what we talked about in the last session if you weren't here and are interested in going back and watching that. It's mostly about budgeting. We learned the benefits of budgeting, defined what a budget is and isn't, some overall guiding principles, some stats, and then finally we really dug in to 5 different budgeting methods. Today, talking about something called the Savings Playbook, and I get asked this a lot about a financial advisor or as a financial advisor. We hear all of these things. You need an emergency fund. You need to be contributing to your 401k. You should be saving for your kids' college. What's a backdoor Roth? All of these things, and a very common question is, what order do I put these things in? And so I'm going to give you a 3-part playbook to think through that process. I will say this, and I'll say it again when it comes up in the slide. There is no one right order for everyone. It really depends on your unique circumstances, but this is just food for thought in putting these things in some semblance of an order. We'll follow that up with taking your money on a date. Like a person, if we don't pay attention to our money, sometimes it doesn't treat us well. And so I encourage clients to take their money on a date at least once a year. And then finally, we'll summarize all the key points from our webinar series and leave time for general Q&A. I see a chat. Oh, great. So this is just a simple reminder, again, from Sammy. Those of you that do have questions, please feel free to put them in the chat and we'll address them as we roll along. I've got to keep our compliance people happy and just state here on the record that all of this information we're talking about today can be considered financial information, but is not financial advice. Financial advice is specific to you as a person. Financial information is general and is things we can all talk about. If you do plan on implementing any of what you hear today, be sure to consult with your financial advisor or CPA or both to make sure that this is appropriate for you and your situation. So here's part 1 of the playbook. And just some general considerations before we jump in. It's only a guide, as I said. Choose your own order that makes sense in the context of your goals, your circumstances, and after speaking with a financial professional. And the last one's really important. I think all of us experience this at various points in life. This is not about having a fear of missing out. If you are on page 1, step 1 of this playbook, it's okay. Financial planning and doing these things is a long-term endeavor, and putting a focused effort for 3 to 5 years against this kind of thing will pay huge dividends and move you well down, well into the playbook here. So Savings Playbook Part 1. And these are the very first things to think about. Again, not necessarily in this order, but this is a bucket of things to start with. We've got having $1,000 in the bank. That's self-explanatory. No need to go further on that. These others we'll talk about a bit more. Think about paying off high interest credit card debt or other forms of debt. Top up your emergency fund, and then save at least enough in your 401k, 401(k), or other retirement plan to get the full match from your employer. So paying off high interest debt. I think we have a poll question coming up. We do. Okay. So, oh, good. And here comes the poll. It's probably covering the slide for some of you. So you might have to drag it out of the way to see it. But you have 3 credit cards. One has a balance of $500 and has an interest rate of about 10%. The second has a balance of $1,500 and an interest rate of 15%. And the third has a balance of $2,500 and an interest rate of 20%. So the poll question is, if these were your 3 credit cards, which of them would you choose to pay off first? Card 1, card 2, or card 3? I have lost my poll question. I don't get to answer because I drug it off the screen. If anybody else is experiencing that, let us know in the chat. But if you could answer, we'll get the answers to come in, and then I think we'll be able to put up the responses that we've gotten once that's available. Although I might have to click over to that briefly because I may have lost that. We'll see. Bear with me here. Is everybody seeing the answers? Because I'm not seeing the answers. I don't know if Sammy or George can talk about whether or not the answers have popped up. There they are. Perfect. Okay, so everybody seeing the answers, or am I not sharing anymore? I'm probably not sharing anymore. Let me try to share again. Okay, so hopefully you're all seeing answers, and we've got about 20% are saying card 1, which is the $500 card, and about 80% are saying card 3, which is the $2,500 card. The correct answer is it's any of them. As long as you're paying down one of them, it doesn't matter which one it is. So by all means, as long as you're getting started with the process, that's the correct answer. Now, we can talk about the various methods that people use for this. And one is called the snowball method, or I kind of like to call it the mind method here, which is the interest rates don't matter. Let's pay off the small one first. Let's get a quick win. We feel great about it psychologically, and it keeps the process moving forward. And the reason why it's called snowballing is as you get rid of minimum payments, those all get transferred to the next card, and the impact that you're making keeps making a bigger and bigger effect on getting things paid down. The other method that people think about, and it's 80% of you chose this, is the avalanche method. Have to give a shout out to my buddy George, who did some great iconography here. I love the avalanche icon in the upper left. And so avalanche is all about paying the highest interest card first. And you get rid of that compounding interest quickly, and your efforts again ramp up in intensity as you're taking those interest rates payments down. So either way is fine. Thank you for answering the question. Okay, then what do I do with paid off credit cards? So one of the things to think about, and I think about this personally, both with credit cards and with investment accounts or other accounts. I assign a job to each of them. And so if a credit card or an investment account doesn't have a job, I don't have a need for it. This personally, again, everybody's different. We have 3 cards and they each have a job. One is for everyday in-person purchases. I'm handing it over at a grocery store, a restaurant, or running it through the gas pump. A second is for online shopping and automated bill paying. I consolidate everything there so that if the card is compromised, it's just one-stop shopping to get that all corrected. Actually learned that after one of our cards was compromised. And then finally is the scary one. This is a card that our college-age children have access to. So those are the 3 jobs that we have. And there are no other jobs in our house for credit cards. And so all of those were just cut up and discarded. So think about things in a job context when you have credit cards. Okay, establishing your emergency fund. I think we have another poll question coming up here. I'm not going to drag it away, so we should be in good shape. Do you have an emergency fund? And we've got a simple yes, no here. There it is from our facilitator. Again, if you can answer that and press submit, that would be terrific. We'll give people the opportunity to do that, and we'll see what our responses are. Once they roll in, I am out of coffee. I don't get to sip coffee. Oh, this is tremendous. Okay, so and it's so interesting how this is laying out. So 80% say yes, 20% say no. Let's go over here and look at some statistics. Thank you again for answering. So we had about 20%, and that's very consistent. About 1 in 4 Americans do not have an emergency fund. And again, if you're one of those, it's okay, because going through this kind of process and putting these steps in place will get you there before you know it. General rule of thumb, think about 3 to 6 months of living expenses. If you're a single earner in a household, think about the full 6 months as an emergency fund. But if you have two relatively equal earners in the household, 3 months may be just fine. And to house your emergency fund, you can consider opening a high yield savings account. Rates aren't great right now. They're hovering down around 0.5%, but I have a feeling with inflation and the Fed raising rates, that will get better in a hurry and will be meaningful interest that you're earning in that account. Matching funds from your 401k. I'm not going to go through this in detail. There's all kinds of different schemes that employers have to match your contributions. We don't really care what the process is. We just want the free money. So if they do a flat match of $2,500, be sure you're contributing at least $2,500. If they do a flat match of 3%, be sure you're contributing at least 3%. Again, it's literally free money as an employee benefit, and you absolutely want to take advantage of it. That wraps up part one. Again, if you have any questions, feel free to drop them into the chat. We'll move along to part two. These are starting to move down now. We've built our financial foundation, so now we're into these middle tier things. So saving for future major purchases, paying off mid-tier debt, such as student loans, and then increasing, or ideally automatically increasing, your 401k contributions each year. So saving for major purchases, especially if you're younger, these tend to come in bunches, but they happen throughout life. So maybe you're thinking about moving from renting to owning. You might be buying a new or used car, or you want to go on a big vacation to celebrate a major event. A lot of people like setting up separate savings accounts so you know exactly how much you have saved toward each. And once you've done that, you can calculate how much you need to save each month to meet your goal timing. And then ideally, again, as paychecks come in, money is automatically distributed. This is an automated, no thought process, and they go out to these goal accounts to keep you on track for these major purchases. Increasing 401k contributions. Again, there's all kinds of ways to think about this. Some people do it on a percentage for percentage basis. So if they get a 4% bump in salary, they bump their 401k contribution up by that much. We have inflation. That's probably not realistic for many people. So maybe you say do it by 50%. So if you get that 4% raise, you bump it up by 2%. I do see a question in the chat. I'll get to that in a second. And then finally, you can increase by a fixed percentage each year. And even a 1% increase over a series of years, which you probably won't even notice in your paycheck as you get raises, has a massive effect on your financial future if you implement this. Some employers are even dialed into this process and will automatically increase your 401k contributions, which is really helpful if you're using that method. So here's the chat question. So if my employer doesn't offer a 401k match or doesn't offer a 401k at all, what do you suggest as an alternative? Okay, so we're going to get to that. And it's in part 3 of the playbook. It will likely be a Roth, and you'll do that if you're below the earning threshold, or if you're above the earning threshold, I would suggest doing a backdoor Roth. And then there's further pages in the playbook that would act as alternatives to that. So great question. Your savings playbook part 3. Okay. So making 529 plan contributions for college-bound current or future kids, maxing out your 401k for those of you who have one. Here's that next page of the playbook that I just talked about, contributing to a Roth or a backdoor Roth. And I would say also, it's interesting that the person brings this up. So I would say here that we would also put a step in here. If you don't have a 401k, you could also do your own IRA, traditional IRA, before you do a Roth. So that's actually a really relevant question here. And I'd insert that between these two steps. And then finally, open up and save in an after-tax brokerage account. So 529 plans, and this is a little controversial to stick the kids in the last page of the playbook here, but this is very analogous to what you hear on an airplane when they say, you know, if we have a problem and the oxygen masks drop down, make sure you put your own mask on before you put it on your kids or other people who may be dependent on you. The same is true with your personal finances. And I've seen this happen so many times where people blow this gaping multi-$100,000 hole in their personal finances to put 2 or 3 kids through school, and it's a mess. And we have a whole half an hour here, so I don't have time to go into why that is, but you understand why that is. And so you really do want to put the financial foundation in place for yourself, and then start stocking away money for the kids. So they are a great vehicle to save for college, 529 plans. When you're contributing, those contributions are not tax deductible. However, growth in the account is tax-free. We've got a question in the chat. Is it a good time to convert traditional IRAs to Roths as approaching retirement in this current climate? Are there income restrictions to do that? Okay, such a good question. So, and this is one of those things where it is very situational. So, if you're approaching retirement in a relatively low tax bracket, then yes, in many cases, it makes sense to do some of these contributions to basically fill up a bracket. And so if you can, you know, fill up the 22% bracket or another low bracket, by all means, do that. If you're approaching retirement in a very high bracket, but you're going to do a clean break from work, it actually will make sense not to do this pre-retirement. But then in retirement, when your income is much, much lower, adopt a multi-year Roth conversion strategy where, again, you're using up those lower buckets and doing these conversions and paying the ordinary income there, ordinary income tax. You'll especially want to do that prior to reaching age 72, because 72 is when required minimum distributions kick in. Those are required, that's the name, and that is ordinary income. So you have this, you know, let's say you retire at 65, you have this 7-year window of being able to do these Roth conversions without having as much income. Great question. Thank you for asking it. Okay. So going back to 529 plans, consider visiting savingforcollege.com. It is the best website as far as I've seen to compare plans. Right now, the Ohio and New York plans are among the best. And some things here, actually, when I started this process with my own children 22 years ago, I did not know a lot of these things. So you do not need to use your home state's plan. Your child does not need to go to college within the state of the plan you choose. So let's say you land on the Ohio plan, for example. You don't need to live in Ohio. They don't need to go to school in Ohio. You're totally free to do what you want there. I'm going to skip this slide. If you are in this boat of saving for college, this is just some really good food for thought about how to go about saving for it, both in terms of how much and what fraction you might expect your student to pay for. So this is here for you at a future time. But then just some other final notes. We've got a chat question. We'll come to that in a moment. A couple other things that a lot of people don't know. Funds are transferable among your kids, or actually any relative. Doesn't even have to be your own kids. But if one spends more than the others, this is one that I worried about, which is what happens if one of my kids either doesn't go to school, doesn't finish. The first choice is to funnel it to one of your other children. But the second choice is this can be multi-generational. And so the money can just sit there and wait for future grandchildren to go to school, and then it can partially fund their education. Here's a chat question. For a 529 plan, can you take the state tax benefits even if you don't select your own state plan? Such a good question. And these are things that you get into the minutiae here and can't cover everything in a half an hour, but let's talk about this. So when you're comparing plans, One of the benefits of selecting your home state's plan, let's say you're in a state like California, which has a very high tax rate, is that the growth within the plan, if you're in the California plan, is not only federal income tax-free, but also state income tax-free. And so you may see higher rated plans at savingforcollege.com, but in certain high tax states, you may consider actually staying with your home state's plan to get that in-state tax benefit. Answering your question directly, if you're in California and you take the Ohio plan, you don't get the state benefit. So really good question. Thank you for clarifying that. Okay. Maxing out the 401k plan, if you guys have that. So this year's maximum is $20,500. This is a $1,000 increase versus last year. We don't have to worry about over contributing. Your employer will shut it off once you hit that maximum. And this is, again, and I probably should have highlighted this multiple times throughout, deciding if and when to do this is really up to you as an individual and what is fitting with your personal finances. Some people never max this out. And it's certainly true for younger people with lots of near-term major purchases, but also for people who are either full-time entrepreneurs, real estate investors, starting a side hustle. Cash is king with those things, and you may be diverting cash to those endeavors and not necessarily maxing out the 401k. Okay, final question or final part, I think, of this. No, there's two more parts here. Contributing to a Roth IRA. So we love Roths. Once the money goes into the Roth, neither your original contribution nor future earnings are ever taxed again. It is fabulous, forever, and tax-free. If you're under 50, the maximum contribution is $6,000. If you're over 50, it's $7,000. If you can contribute to a regular Roth IRA, if you're under the income limits, that's the way to go. If you're over the income limit, do a backdoor Roth each year. The big caveat here is this is very clean and simple and easy if all of your money is within a 401k plan. If you have other IRAs, the backdoor Roth will actually be subject to the pro rata rule. And if you're not careful, it won't work. And a lot of it will just, the transfer will be ordinary income. And so again, that's one to consult with a financial advisor or CPA on the specifics as to whether you can do a backdoor Roth each year. Those are Roths. And then finally, we can talk about opening up a brokerage account. I'm going to skip this in the interest of leaving time for any questions and also the summary and taking your money on a date. Got a lot to cover, so we'll just roll right on past that. And we'll cover the takeaways in the final part. We're going to move along to taking your money on a date. So it's February, we have Valentine's Day. Money is just like a person. And if we don't pay attention to a person who's important to us, they might not treat us as well as we'd like. Same is absolutely true of your money. And so I am a big fan of taking my money on a date at least once a year. So there's all kinds of things you can do on this money date. You can look at changes in circumstances, goals, major purchases, budget, emergency fund, where you are in the savings playbook that we just talked about, and your net worth. I'm going to skip a number of these. A lot of these are very self-explanatory. Of course, if you have a major change in circumstances, it may dramatically affect how you choose to save and spend. So having a baby, getting a promotion, those are good things. Not as good things, gap in income, major expenses. So factor in changes in circumstances. Review your goals. And again, those can change, especially as you have changes in circumstances. Think about upcoming major purchases. And we list some here. And then also think about how you plan to pay for them. And some things you may do as cash, like a vacation. Some you might seek external financing, like a car. And some you might self-finance through a home equity line of credit, for example, if you're doing a home remodel. Review your budget. This one's important. You know, and I have a lot of high level things here to think about. Is it helping you meet your savings goals? Does your budget help you set aside money for major purchases? Number 3 is big. I don't know, before implementing a budget, there was just a lot of money drama for us, and running around when things didn't quite go perfectly in a year, which, I mean, especially the last few, how many have gone perfect? And then finally, is the specific type of budget that you're using working? Do you need to be a little more rigorous and maybe implement, either partially or fully implement, the envelope method? Or can you take a step back and do something that takes less time because things are working for you? A chat question. Do you use a checklist of items to cover when you take your money on a date? How do you determine which items to cover during this date? Like all of this, this is very personalized to you. And so I've outlined everything. You may choose only 3 things from this list that are important to you. So maybe it's a look at your budget, and is that working? A quick look at circumstances, and a check on your net worth. And that may be plenty to do exactly what you need. Other people may select to go through all of these. And so, you know, my checklist is exactly what you see here. And that's what I bring into this exercise every year when I do it. Great question. Okay, no more questions there. Emergency fund, self-explanatory, moving on. Setting new savings related goals, self-explanatory, moving on. Okay, net worth. So, and again, I love the huge house-sized gem that this person owns in our iconography there. So net worth, it is not a mystery how to do this. You total up everything you own that has value, and you can see the list here. Next, you total up what you owe in the form of mortgages, loans, and other, maybe even people that you owe money to. And so your total net worth is total assets minus total debts. And then this is a really good single number that gives you a great snapshot into how things are going financially. Did this increase or decrease? I mean, let's face it, we're having a pretty lousy year in the market this year. So if we're flat from here forward, there will be a lot of people who might show a decline in net worth this year. That's okay. It's not, we're looking at this not only in isolation, but also over a 5 to 10 year period. Is it fitting with your long-term financial plan or retirement plan that you've either developed yourself or with an advisor? Are your investments working for you? Does it suggest any changes? And then, you know, we've talked a lot on the savings side of things. We haven't talked a lot about the income side of things in this webinar series. And so, am I satisfied with how much I'm making? And if so, great. And if not, am I looking for promotion, job change, side hustle, or something else? And what plans do I have in place for that? So, concluding thoughts from our entire series here. Now, this is seminar 1. All of us are feeling uneasy to a certain extent as we work our way through the pandemic, whether that's related to money or life in general. COVID has caused major changes in how we spend and save money. And so think about this year as a reset in terms of how you think about spending, saving, and major purchases. With budgeting, if money is not working for you, think about implementing a budget or changing to a different method. Be very patient with yourself through this process, not only in terms of finding what's right for you, but also for a lot of people, budgeting doesn't feel great when you start. But after you've done it for a while, it can actually be very liberating and again, take a lot of the money drama out of your life. Savings Playbook, we covered it today. Regularly evaluate where you are in terms of your goal. It is totally fine if you're on page 1, step 1 of the process. This is something that you'll commit to for multiple years and will pay huge dividends for you over time. And then finally, decide which steps and in what order are right for you. Everyone's life is totally different. Taking money on a date, Give your money some love and attention. It will treat you better. Think about that money date at least once a year. Evaluate all of the things in the checklist that I proposed, or a fraction of them. It's far better if you have half an hour. It's far better to spend that half an hour on 3 items in the checklist than, oh my gosh, I have to do all these things or it won't be right. Not so. And that is it. We are on the dot for time. Thank you so much for taking part in today's webinar. If you didn't catch it all, or if I was rambling too fast, it's no problem. Mara will be sending a recording and a summary of the session via email. So if any of you have to go, that is totally fine. I am here to answer questions for a few more minutes if you have them. Otherwise, we will call it a day today. And thank you so much for attending. There is a chat question coming in. I heard something about the backdoor Roth going away last year. Is it still allowable? Yes, the backdoor Roth is always on the chopping block. And, you know, if we just think about this philosophically, the backdoor Roth, or the Roth, was designed for lower income households to have a tax advantaged way to save for retirement. But they've created this loophole that everybody can take advantage of. So that's why it's on the chopping block every year. It's still allowable, and I would absolutely take advantage of it if you can this year. Got a question specifically on what is a backdoor Roth? Okay, good question. So there's a lot of mystery surrounding this process, and the mechanics are very simple. You will open up 2 accounts side by side. I would keep them clean and use them only for this process and not commingle any other funds in there. One will be a traditional IRA account, and the other will be a Roth account. You will, if you're, let's just say you're under 50, you will make a $6,000 after-tax contribution into the traditional account. You will wait 2 days, and then you will transfer the money into the Roth. And it's completely permissible in the tax code. And hundreds of thousands of taxpayers do this every year. You'll want to alert your CPA if you use one that this $6,000 was an after-tax contribution. So there's no confusion there. And finally, again, the big watch out here is if you have other IRAs, don't bother with a Roth because it's just going to be mostly considered ordinary income anyway, the transfer. Skip to other methods of saving for retirement. And also, if you have a 401k, just to overcomplicate things here, you can see if what is called a mega backdoor Roth is available within your 401k. And if so, it's another way to save for retirement. Any other questions before we wrap it up for today? Okay, looks like that's it. Thank you all for attending. I hope you have a great day and a great weekend coming up. Take care.